Welcome to this explainer on Beta Drugs. Today, we're unpacking their Q4 FY26 earnings call, and honestly, it is a fascinating case study. This is a year where they faced some seriously tough market setbacks, yet somehow they managed to execute this incredibly ambitious, high-margin pivot. We're going to dig into the strategy and the major structural shifts happening right beneath the numbers. Okay, let's just jump right in with a number that kind of blew my mind. 22.57%. That is Beta's newly improved EBITDA margin, essentially their core operational profitability. Now, if you've been following the broader pharmaceutical space lately, you know this past year hasn't exactly been a walk in the park. It's been tough. But this one single metric proves that Beta's profitability actually went up, despite facing a highly challenging operational year. So how on earth did they pull that off with the wind completely against them? Well, here's our roadmap to find out. First, we'll take a quick look at their FY26 financial snapshot. Second, we'll unpack how they navigated the platinum setback. Third, we're driving into their branded and export growth, followed by their diversification into derma and IVF. Finally, we'll wrap up with their massive Vision 2030 revenue roadmap. Starting with Section 1, FY26 Financial Snapshot, Growth with an Asterisk. So, looking at the top line, net revenue climbed from 368 crores in FY25 to 396 crores in FY26. And hey, on the surface, growth is growth, right? But management was actually incredibly candid on the call. They admitted this top-line trajectory wasn't nearly as explosive as they'd originally forecast. Basically, there was a definitive drag on their ultimate revenue potential this year. But here is where it gets really interesting. Beneath that somewhat modest revenue growth, their operational efficiency just absolutely shined. I mean, look at how these margins expanded across the board. Gross margins ticked up from 52.71% to 55.52%. That EBITDA we highlighted earlier, up from 21.1% to over 22.5%. And operating margins saw a really nice bump too, moving from 17.65% to 18.11%. The takeaway here? They are literally making more profit per rupee earned right now than they were last year. Which brings us to the absolute elephant in the room regarding these Q4 results. If their operational efficiency is running that hot, what exactly were the external factors dragging down their overall sales momentum? What forced that top-line growth to miss their initial targets? That brings us to Section 2, Navigating the Platinum Setback, the Margin Dilemma. So here's the core of that dilemma, and the math on this is just brutal. Beta used to do around 30 to 35 crores of business from platins alone, but the government's price cap for carboplatin currently sits at 2,850 rupees. Meanwhile, their manufacturing cost hovers painfully close to that, between 2,300 and 2,400 rupees. By the time you factor in the mandatory margins for retailers and wholesalers, there's literally zero profit left. None. So faced with this totally uncontrollable pricing dynamic, Beta made a really tough but honestly necessary strategic choice. They halted domestic platin sales entirely. And pulling the plug on that supply had an immediate knock-on effect. Their CDMO, or Contract Development and Manufacturing segment, basically flatlined. It crept up by just 1% to 149 cores. Management actually noted that if they had just kept supplying platins, CDMO sales would have naturally increased by 7%. So this stagnation in the CDMO business completely masked the incredible underlying strength of their other divisions. Let's look at that strength in Section 3, Driving Branded and Export Growth, the High-Margin Pivot. When you realize they couldn't control platin pricing, you see that Beta Drugs did exactly what a resilient company should do. They doubled down on the areas they could control. And man, these specialized verticals are just thriving independently. Branded oncology jumped an impressive 20%. Dermatology surged by a whopping 35%. And their API business, the active pharmaceutical ingredients, grew by 25%. This right here, this is the actual core engine of their business health. Now, you might be wondering, hey, what about exports? Well, their export business actually shrank temporarily by 11%, dropping down to 71 crores. But wait, this wasn't a lack of demand. It was a classic case of bureaucratic red tape. They had massive public sector tenders lined up to win in December or January, and they just got pushed back 4 months to March. So roughly 25 crores of expected revenue basically just shifted right out of FY26 and straight into the next fiscal year. But hey, here is the massive silver lining to that delay.
Because those tenders are now fully secured and the supplies are shipping, management is confidently projecting a jaw-dropping 50% growth in export revenue for FY27. They're targeting between 105 and 110 crores. So the revenue wasn't lost at all, it was just deferred. And this fits perfectly into their broader long-term export strategy. It's a really aggressive playbook. Step 1, submit over 200 dossiers globally. Step 2, maintain a laser-focused regional approach where 30% of their sales consolidate into just 5 key target countries. And Step 3, clear vital European regulatory hurdles, like their highly anticipated EU GMP audit coming up in the first week of September. Moving to Section 4, diversifying with derma and IVF, entering new super specialties. Beta is no longer just an oncology company. They are aggressively evolving into a multi-specialty powerhouse. Just look at their dermatology arm. We mentioned it grew 35%, but management also announced it has officially become EBITDA positive. They're now targeting 50 crores in revenue within 3 years. And they're doing this by securing exclusive European tie-ups for super high-margin premium cosmetology products, stuff like fillers and mesotherapy. But without a doubt, the biggest headline of the year was their acquisition of Niben. Beta secured a 66.1% majority stake in this booming fertility brand for 69.4 crores. Niben is already generating over 45 crores in revenue, which gives Beta an incredibly strong, immediate foothold in the IVF space.
And to really understand why this is such a game changer, you have to look at the total addressable market for IVF in India. It's massive. It currently sits at a staggering 2,000 crores, and it's growing at an incredible 17% every single year. Beta Bung is stepping into a huge arena with a ton of natural momentum behind it.
The strategic synergy here is almost too good to ignore. Right now, only 3 lakh patients are being served out of 12 to 15 lakh eligible cases in India. That's a huge untapped market. And by utilizing their 4 decades of pharma leverage, Beta can step in, slash Niven's raw material costs, and plug these IVF products directly into the massive corporate hospital networks where Beta already has deep established relationships. Plus, and this is key, management expects 0 margin dilution because Niben already hums along at a very healthy 18 to 19% EBITDA. And finally, Section 5, Vision 2030 Revenue Roadmap, doubling the base. All of these moves, cutting the low-margin platins, pushing derma, acquiring IVF, they are all meticulously calculated steps toward a much grander objective. This projection completely redefines who Beta Drugs is. They are consciously stepping away from the turbulent CDMO business, shrinking it down to just 13% of their mix. Instead, they're going all in on branded formulations, projecting that to dominate and make up over half of their total revenue at 51%. And the management team has drawn a massive line in the sand. Their target? They want to more than double their current revenue base over the next 4 years. They are aiming to take that 396 crores from FY26 and scale it up to an astronomical 850 to 900 crores by 2030. But here's the absolute kicker, especially if you're looking at this from an investor's perspective. Management claims they can hit 700 to 800 crores, quote, easily without doing any major investments. This means no massive debt-inducing capital expenditures are on the horizon. They just need to execute using the manufacturing capacities they've already built and have sitting idle. So they've built the capacity, they've snapped up high-growth super specialties, and they've shown they aren't afraid to cut the dead weight of price-capped generics. As we wrap up this explainer, I'll leave you with this to chew on. Will this swift navigation of market setbacks and bold M&A strategy truly redefine their market dominance by the end of the decade? Thanks so much for joining us for this explainer, and as always, keep learning.